Hi everybody. In our previous video, we discussed the accounting for a bond issued at par. In this video, we'll discuss the accounting for a bond issued at a discount. When the stated or contract interest rate is less than the market or effective rate of interest, the bonds will be issued at a discount. Several things to remember about that. The stated or contract interest rate is the rate specified by the bond indenture. It is the rate of interest to be paid to the bondholders over the term of the bond. The market or effective rate of interest is equivalent to the interest that is being paid on other bonds of similar risk and maturity. One way to look at it is this. If our bonds are paying less interest than the potential investors could earn by buying someone else's bonds, then we will need to sell our bonds for less than the par value in order to attract investors. An investor might pay only $475,000 for a $500,000 bond, but at maturity, the bondholder is actually going to get paid the full $500,000 par value. Keep in mind that this discounted issue price is calculated to equalize the yield on the bonds with a more attractive market rate of interest. We will work bond issue price problems using present value tables in a later video. For now, though, let's work another problem where you are either given the bond issue price outright, or you can easily calculate it without referring to the present value tables. On June 30th, X1, ABC Company issued an 8% 3-year bond with a par value of $250,000 and semi-annual interest payments. On the date of issue, the annual market rate of interest for these bonds is 10%, which implies a selling price of 94.92. So you are given an easy way to calculate the issue price of the bonds. If these bonds were being issued on the stock market, they would be listed at 94.92, and what that means is the par value times 94.92% is the issue or selling price of the bonds. So go ahead and calculate the amount of cash to be received upon issuance, and then prepare the journal entry to record the bond issuance. Start your video again to check your work. So the issue price of these bonds is $237,300, calculated at the par value $250,000 times 94.92%. Debit cash $237,300. Credit bonds payable the full par value $250,000, and debit discount on bonds payable for the difference between the two to get this journal entry to balance. Remember that discount on bonds payable is a contra liability account. It attaches itself to bonds payable and has the opposite normal balance. Let's prepare an effective interest amortization table for this bond. On the issue date, June 30th, X1, the bond had a carrying value of $237,300. The carrying value is the issue price minus the discount on bonds. Remember, discount on bonds has a debit balance. The bonds payable has a credit balance. They subtract from each other to calculate the carrying value, which is also known as the amortized cost or the outstanding balance. Column A is cash interest paid, and it's calculated as the face value multiplied by the semi-annual stated or contract interest rate. Column B is the prior period's amortized cost multiplied times the semi-annual market interest rate. Column C is the difference between these two. Take your interest expense, subtract the interest paid, and that's your amortization of the discount. Column D is the prior period's discount balance minus the amount you calculated here. And column E is the face value, $250,000, minus the unamortized discount. Why don't you go ahead and calculate all of those numbers for 1231X1 loan payment. When you finish, start the video again to check your work. The cash interest payment is $10,000 for every loan payment or interest payment. That's calculated at $250,000, the par value of the loan, times 1/2 of the contract interest rate. The interest expense is calculated at the prior carrying value times 1/2 of the market rate of interest, or $11,865 for the December 31st X1 bond interest payment. That number will change every time. This number will remain the same. This number will be different every time. The difference between these two is $1,865. And if you take the prior discount balance and subtract the $1,865, you now have the new balance in the discount account, $10,835. And the carrying value of the bond is the par value of $250,000 minus the unamortized discount of $10,835. That equals $239,165. Did you get them all? If you did not, go ahead and fix your work, understand where you made your error, and then carry on. Go ahead and calculate all of these numbers for everything through, well, go ahead and calculate it all the way through 630X4 payment. You will have a rounding problem. I'll show you how to fix it. Start your video again when you're finished with the amortization schedule. So the name of this game is to amortize the discount down to 0. And as the discount gets smaller, the carrying value grows. And at the end of the last payment, the carrying value should be the full $250,000 par value. We're off $15. That $15 is a rounding error. So what we need to do is to force our interest expense up by $15, which will cause this to be 0 and cause this to be a full $250,000. If I add $15 to this balance, it calculates at $12,395, which then makes the amortization of the last bit of discount down to 0 and brings the carrying value up to $250,000. Excuse the noise in the background. I have a new puppy and he's feeling his oats right now. So go ahead and prepare the journal entry to record the first semi-annual bond interest payment using the effective method. You can get the numbers from this schedule. The first bond interest payment, cash paid, is $10,000. Interest expense is $11,865. And amortization of the discount is $1,865. These three numbers will make up your journal entry for the first bond interest payment. So for this payment, bond interest expense is a debit of $11,865. We're going to credit cash for the $10,000 actually paid. And this $1,865 is a credit to discount on bonds payable. And the last thing you're asked to do is to record the journal entry for the 5th semi-annual bond interest payment. Well, if this is 1, 2, 3, 4, 5, you're going to use the numbers for the 1231X3 payment. Go ahead and write that journal entry. Debit bond interest expense, $12,267. Credit on bond discount on bonds payable, $2,267, and credit cash, $10,000. Well, that's all for this video. In our next video, we'll go through the same procedures to discuss a bond issued at a premium. See you next time.